Inflation is a natural part of any economy. It means prices rise gradually over time, reflecting growing demand, rising costs, or changes in supply. A little inflation can be healthy, encouraging spending and investment. But when inflation stays high for an extended period, it can create serious problems that ripple through every part of society, from everyday consumers to businesses, governments, and financial markets. So, what exactly happens when inflation remains persistently high in the United States? First, let's talk about purchasing power. When inflation is high, the prices of goods and services increase faster than wages for many people. This means the average consumer's dollar doesn't go as far as it used to. Essentials like food, housing, gas, and healthcare become more expensive, straining household budgets. For families living paycheck to paycheck, this can mean cutting back on non-essentials or even essentials, leading to a decline in overall quality of life. This erosion of purchasing power also impacts savings. If inflation outpaces the interest rate on savings accounts or fixed income investments, people's savings effectively lose value over time. This is especially painful for retirees or those relying on fixed incomes who can't easily increase their earnings. It discourages saving and can create financial insecurity across large segments of the population. Businesses feel the pressure too. High inflation increases costs for raw materials, labor, and transportation. Companies may respond by raising prices, which can reduce consumer demand, or by cutting costs elsewhere, sometimes by freezing wages, reducing benefits, or delaying investments in growth and innovation. This creates a challenging environment where businesses struggle to plan and budget effectively due to price uncertainty. In some cases, high inflation leads to a wage price spiral. Workers demand higher wages to keep up with rising costs, and businesses facing higher labor expenses raise prices again. This feedback loop can be difficult to break without significant intervention. Interest rates are another key factor. To combat inflation, the Federal Reserve often raises interest rates, making borrowing more expensive. While higher rates can slow inflation by cooling demand, they also increase costs for mortgages, car loans, business loans, and credit cards. This can dampen economic growth, raise unemployment, and create a risk of recession if rates climb too high for too long. Long-term inflation also impacts the government's finances. On one hand, inflation increases tax revenues as incomes and prices rise. On the other, it raises government spending on programs indexed to inflation, such as Social Security. Furthermore, if inflation causes higher interest rates, the government's cost of servicing its debt grows, potentially leading to larger budget deficits. Another important consequence of persistent inflation is its impact on financial markets. Investors may demand higher returns to compensate for inflation risk, raising borrowing costs for businesses and governments. Stock markets can become volatile as companies' earnings get squeezed by rising costs and uncertain consumer demand. Bond markets also suffer since fixed income returns become less attractive when inflation erodes their purchasing power. For everyday people, long-term inflation can create uncertainty and anxiety. Planning for the future becomes harder when you don't know what prices will look like next year or the year after. This uncertainty can reduce consumer confidence, which in turn slows spending and economic growth. High inflation can also exacerbate inequality. Those with assets that appreciate with inflation, like real estate or stocks, may see their wealth grow, but low-income households, who spend a larger share of their income on essentials, suffer disproportionately. This can deepen social divides and create political pressure for change. So, what can be done if inflation stays high for a long time? Central banks play a crucial role. The Federal Reserve's main tool to fight inflation is adjusting interest rates. By increasing rates, the Fed makes borrowing more expensive, which can cool off spending and investment, slowing inflation. But this has to be done carefully. Too much tightening risks pushing the economy into recession, while too little allows inflation to spiral further. Fiscal policy matters too. Government spending and taxation policies can either fuel inflation or help control it. For example, large deficits financed by printing money can worsen inflation, while prudent budgeting and targeted spending can support economic stability. Structural reforms can also help reduce inflationary pressures. Improving supply chains, investing in productivity-enhancing technologies, and increasing labor market flexibility can ease cost pressures in the economy. Importantly, clear communication and managing expectations matter. Inflation can become a self-fulfilling prophecy if businesses and consumers expect prices to keep rising and act accordingly. Transparent policies and credible commitments from the Federal Reserve and government help anchor inflation expectations and maintain confidence. In conclusion, prolonged high inflation in the US can have wide-ranging and serious consequences, from eroding purchasing power and savings to disrupting business operations, increasing borrowing costs, and deepening inequality. It requires coordinated efforts from central banks, governments, and the private sector to restore price stability while supporting economic growth. Understanding these dynamics is essential because inflation affects everyone, whether you're a consumer, a worker, a business owner, or a policymaker. Keeping inflation in check is a delicate balancing act, but it's critical for a healthy, prosperous economy.